Today, we are putting on our detective hats. Our case involves one of the most common challenges in consolidation accounting: finding and properly accounting for unrealized profit on sales between a parent and its subsidiary. This requires careful investigation and a sharp eye for detail. Let's get started. Before we dive into the evidence, we must review the golden rule of our investigation, our mission: to ensure the consolidated company only recognizes profit when inventory is sold to an outside party. The challenge arises when the subsidiary still holds some of the transferred inventory at year-end. In that inventory sits unrealized or paper profit. Our task is to find the exact amount of this hidden profit and correctly defer it until it's truly earned. Every detective needs their toolkit. For this job, we have two primary tools to determine the profit percentage on the internal sale: the gross profit rate, GPR, and the markup on cost, MC. The GPR asks the question, how much of every dollar of the sales price was profit? The markup on cost asks a different question: how much did we mark up the product from its original cost? Both are valid tools, and knowing which one you're using is critical to cracking the case. Let's look at our first piece of evidence from the case file. We have an internal sale with a transfer price of $1,000 and an original cost of $800, giving us a $200 gross profit. If we apply our tools, the gross profit rate is $200 divided by the $1,000 sales price, which is 20%. The markup on cost is $200 divided by the $800 cost, which is 25%. The key takeaway here is simple. These are just two different ways of looking at the exact same $200 profit. For most of our consolidation work, the GPR is the most direct tool to use. Now, the case gets interesting. Our client, Arlington, sold $80,000 worth of inventory to its subsidiary, Zircon. By the end of the year, Zircon has sold most of it to outside customers. That profit is now real and has been earned. We don't need to worry about it. Our mission as profit detectives is to focus only on the inventory that is still on hand. The clue is that $20,000 of that inventory is still sitting in Zircon's warehouse. Now we solve the puzzle. We take our clue, the $20,000 of inventory still on hand, and apply our tool, the gross profit rate. We know from the case file that the GPR on the original sale was 37.5%. The calculation is straightforward. Ending inventory at transfer price times the GPR equals our unrealized profit. So $20,000 times 37.5% equals $7,500. This is it. This is the hidden profit still sitting in ending inventory. This is the amount we must defer. And here is the final step in our investigation for this year: making the worksheet entry to defer that profit. We use consolidation entry, G. We debit cost of goods sold for $7,500, and we credit inventory for $7,500. Let's think about the effect. The credit reduces the inventory asset on the consolidated balance sheet back down to its true original cost. The debit increases cost of goods sold, which correctly removes that $7,500 of paper profit from our consolidated net income for the year. Case closed until next year, when we'll have to solve the mystery of how to recognize this profit.